Hello everyone. In this video I'm going to talk about an important part of your chapter 7 and this part is related to the Fed, the Federal Reserve Bank, and the money supply. I'm going to write it as M to the power S. So basically what I want to talk about is how the Fed is able to change money supply or affect money supply. So based on your readings of this chapter, you already know that we have what we call the monetary base. And the monetary base is basically consists of two important parts. The first part is the currency in circulation plus reserves. Okay, so we have two important parts, which is of the monetary base, which is the currency in circulation and the reserves. So as you also know that the money supply is equal to the money multiplier times the monetary base. Okay, so if the Fed can affect reserves, then it can affect the monetary base, and in turn the monetary base can affect the money supply. Okay, in other words, we can write this link as follows. If the Fed can have an effect on the monetary base, right, then the Fed would have an effect on money supply. But the question is how the Fed affects the monetary base. And to be more specific, we said in the previous slide, the Fed can affect reserves, and actually reserves, sorry for the typo, okay, it can affect reserves, and actually reserves is a part of the monetary base, and the monetary base is actually going to affect the money supply through its multiplication with the money multiplier. So our important link that we're looking into is Fed money supply. The next question is how the Fed can affect reserves. You know that banks have a balance sheet and the banks are supposed to hold certain amount of their deposits as reserves, which we call the required reserve ratio. And I'm sure that most of you know from the discussion of week number 2, which is discussion 1, we were talking about the required reserve. Many of you were talking about the required reserve ratio. So the required reserve ratio is certain percent out of deposits that the Fed asks the banks to hold on their balance sheet, just in case someone is coming to ask for their money back, so they have certain amount in reserves. But they also do hold more than what is required, and this actually happened after the financial crisis of 2007 to 2009. So part of this reserve is actually required, but also there is an addition, based on what the banks and financial institutions want to hold in their balance sheet. So the Fed can affect these reserves by what we call the open market operations. And the open market operations is basically undertaken by what we call the Federal Open Market Committee. Okay, so the Federal Open Market Committee is actually the committee that is taking care of the open market operations. But the question is, what is open market operations? So the open market operations is basically the act of buying and selling U.S. Treasury securities. Okay, so whether the Fed is buying or whether the Fed is selling. Okay, so if you imagine like this is the Fed and these are the banks and financial institutions. So this is just like, if you imagine, these are the banks and the financial institutions, and suppose that the Fed is buying the US Treasury security, which is just a piece of paper. So if they are buying from these banks the US Treasury securities, then they are basically kind of taking kind of a piece of paper, right? Which we call it like the Treasury security, and they are giving back the money in return for this piece of paper. So they are kind of inputting money inside the balance sheets of these banks. Okay, and if these banks and financial institutions have money that is coming in to their balance sheet, they are basically going to put it into their reserves. So if you imagine that let's take the buying, because the selling is just the opposite. So buying US Treasury securities. Okay, so if the Fed is going to buy, then the Fed is going to pay money. To whom? To the banks and financial institutions. Of course, these are not any banks, not any financial institutions, but these are called primary dealers, and they are actually registered with the Fed. Okay, and you can actually look for these primary dealers online. You can Google search their names. So what the Fed is doing is basically buying like the US Treasury securities, paying money, and then this money is going into the balance sheets of these banks, or you can be more specific and say this would increase their reserves. Okay, and if this increases the reserves, then the banks and financial institutions, if they have reserves more than what is required, and if we assume that they want to make loans, because they might just keep it, but if we assume that they want to take what is extra, or what is over and above the required amount of reserves, and they want to lend it, this would mean an increase in loans. Okay, and if loans increases, this basically means, it's like, if you can think about it this way, if you are a person and taking a loan from the bank, then this can either increase your currency in circulation, or you can put it as a demand deposit. You can just put it in your checking deposit in the bank. This, like, you can put half here and half here, or third and two-third, whatever, but we don't care about what is the combination of which one now, but what is ultimately mean that these two components are already in the definition of money supply. Okay, so if you increase the loans, then this would increase the money in the hands of people, right? Whether you want to consider it as currency in circulation or in the checking account as demand deposits. But in either case, this means that these are the two components of money supply. So ultimately, money supply will increase. Okay. So this process, I'm just like trying to simplify it as much as possible. If you want to think about just the opposite story of selling, selling would be just the opposite. So selling US Treasury securities by the Fed. So the Fed is the one who is selling now. So if you imagine that the Fed is selling, then the Fed, and these are the banks. So the Fed is giving back the piece of paper, and he's taking the money out of the financial institutions and banks. So it's kind of absorbing the liquidity out of the market. So in this situation, the Federal Open Market Committee would be doing an operation of selling, and the selling of US Treasury securities basically means that, right, you are kind of selling you're kind of taking the money out of these banks. You are basically reducing reserves. This would reduce the loans. This would reduce the, you want to say, currency in circulation and or demand deposits. In any case, these two are components of money supply. In other words, money supply is going to fall. Okay, so the link between the Fed and the money supply is actually through how they affect reserves. And they are affecting reserves through the Federal Open Market Committee. And they are affecting reserves by either selling or buying US securities. Okay, through what we call the open market operations. Okay, it's very important to understand this link because if you understand this link, then we will keep kind of expanding this analysis more as we proceed in this chapter. Okay, everyone, I'm going to stop here.